There was a huge condo that collapsed in Florida, and a few years ago there was a balcony situation up in the Berkeley, California area where there was a major issue as minor as a kid stubbed his toe at the pool, and now they're suing the HOA.
And I tell you that because I own a condo in Camarillo, and they came to me very early on like, we want to sue the builder, and I was like, no, I'm not for that. We had one where there was one investor that owned more than 51% of the units basically in that complex.
So it's not a death sentence, it's normally just a temporary hurdle to get over for your situation.
Welcome back to another episode of the Morales Group podcast. Today we're diving into a topic that can make or break a condo transaction. It's called non-warrantable condo financing. So the reason we're bringing this topic up is we've had several situations recently where a buyer wants to buy a property, seller wants to sell a property, and the condo association or the loan is what's considered a non-warrantable HOA, which makes the financing a little bit more difficult. Today, to help us with that, we got Michael Yates, who specializes in condo financing. We're going to go over what makes a condo non-warrantable, how agents and buyers can identify potential issues before writing an option, what financing options currently exist for those buyers, and what real estate professionals should know to avoid surprises during escrow when financing a non-warrantable HOA condo. Welcome back to the podcast, Michael. How are you?
Good, Jose. Thanks for having me again.
All right, so let's start off. What makes a condo project non-warrantable?
So basically, most loans under $1 million are normally backed and insured by Fannie Mae or Freddie Mac, and they want to have a warrantable condo. And that means that everything kind of checks their boxes as far as the guidelines go, as far as the budget in place, proper insurance. They want to make sure there's, just certain line items are checked off in the condo project. The HOA is a good standing. And we'll go over some of the items that make it non-warrantable in a minute. But the main thing is if it's not going to be able to be kind of backed by Fannie Mae or Freddie Mac with a traditional conventional type loan, that's where we kind of come into play here with the non-warrantable condos, and we'll handle some of those issues. So some of the items that will make a condo project non-warrantable, one of the biggest things is if there is ongoing litigation going on in the project. It could be something as minor as a kid stubbed his toe at the pool and now they're suing the HOA, or it could be as major as building defects from the builder, issues with structures, that sort of thing. That's where it comes into problems with litigation. And there's quite a few others here that we can kind of dig into as well. But that's the biggest one that really kind of blows things up is litigation.
Yeah. And I think this is important for both sellers and buyers because obviously this impacts it. So let me ask you this. If an HOA is warrantable, what loan products are available? And then if the HOA is non-warrantable, what does that mean for loan products in terms of down payments and interest rates?
Okay. If it's warrantable, then you're looking at the full gamut of products as far as traditional, conventional financing with as little as 3% down or 5% down. In most cases, you have to make sure that a project is FHA approved. If it is FHA approved, then we can do 3.5% down. And we can also take a look and see if it's VA approved. If it's VA approved, they can do it with 0% down. But if it's warrantable, traditional financing products that have the best pricing options are generally always allowed.
That's awesome. Okay. And then if it's non-warrantable, what type of loan products are available in those situations?
So a non-warrantable, so what we do is we have access to a lot of lenders that offer non-QM products, non-qualified mortgage products, which are non-traditional financing. So some additional items that might pop up that will make a condo non-warrantable would be items as, say there's a high concentration of one entity or one owner owning more than 10 or 20% of the units in a complex. That's a major issue as well. More and more, we're seeing a lack of insurance going to the condo complex. Insurance is just one of those things, whether it's a single family home or a condo complex, that's, just kind of, especially here in California, always kind of giving us a little bit of a curveball here and there. Sometimes if there's short-term rentals going on in the project, that could be an issue. And then if there's budget issues, so when we get the budget, review that. If it's not enough reserves, that could be an issue as well. So when we get a new condo in, we have to send a form over to the HOA, and they complete it, and it has, some could be as long as 4 pages, some could just be 1 page, and they're going to ask a lot of questions, and based on what the answers come back with, then the underwriter can determine if it's warrantable or not, or non-warrantable.
Got it. Now, just for our viewers to kind of like understand simply what we're referring to, if it's warrantable, then you've got almost every product available, lower down payment, 3, 5, 10, 15% down. If it's non-warrantable, to my understanding, it's usually a higher down payment, maybe 15 to 20%. And to my understanding, the interest rate is higher as well too, maybe by up to a point. Would that be pretty accurate?
Yes. With the non-warrantable condos, we need, in most cases, at least 10% down. If you can do 20% down, you're going to be more into a market rate type situation with a slight increase. So if you're in that 10 to 20% down range there, rates are going to be probably, right now where market rates are 6.5. On the non-warrantable condo project, when it's between 10 and 20% down, you're going to be looking probably somewhere in the low to mid 7s. Now, if you can put down 20% or more, even though it's a non-warrantable condo, you're probably going to be about 0.25 or 0.375 higher. So slight increase, but it's really not that bad.
Okay. Why is this important for buyers and sellers? The reason this is important for buyers and sellers is if you're selling a property with a non-warrantable HOA, there's a smaller buyer pool that are going to have the 20% down payment. And there's potentially a smaller buyer pool that would be willing to take a higher rate if you've got less than the 20% down payment. So it basically, what I've been seeing recently is that it narrows down the buyer pool a little bit, which in some cases affects supply, and in some cases it affects prices. Now, where I've been seeing is that HOAs have been warrantable, and all of a sudden the FHA approval or the VA approval expires, and now the Fannie Freddie are requesting additional documents, and now they're saying, oh, like based on these documents that we received, we don't like the reserves, we don't like these extra repairs that are going on with the balcony. It currently is not a warrantable HOA at the present moment. And then I'm seeing some changes in the marketplace as it affects to that. Now, I ran into this with a loan officer where the loan officer, the moment it opened up escrow, they checked this system. It was like a Fannie Freddie system. And that system let them know whether the HOA was warrantable or not warrantable, approved, not approved. What is this system called? And do all loan officers have access to that?
Yeah, so Fannie Mae has an approved condo list that is generally published on their website. You have to just go to Fannie Mae and just navigate through it, but they will normally have an updated condo list on there. Now, even though it's approved, most cases we still have to get what's called that HOA certificate completed. So once that is sent back from the HOA, we submit that to the bank, and they will still review it just to make sure everything's is in place, and they can still find items on there that could be a red flag. And you mentioned the SB 326 report. So that is just a small balcony 326 report that kind of has thrown a major wrench in the system too the last couple of years. So a few years back, there was a huge condo that collapsed in Florida. And a few years ago, there was, I think it was a balcony situation up in the Berkeley, California area where there was a major issue that has triggered the Fannie Mae and Freddie Mac to really kind of hold lenders more accountable with these HOA certificates. And so back in the day, they would just, oh, have you had a structural engineer's report done? They would just say no and move on. Now, they want to make sure that that box is yes, and that it has been received and signed off. And if not, they'll even go back and they'll ask for copies of the minutes from the HOA going back 12 to 24 months. And they'll review that to see if there's any safety or health issues going on with the complex. So even though you get the green light from Fannie Mae approval, you still have to get that form, and it can still raise some red flags and cause issues. So that's why it's really important before you get even into escrow for the selling agent and the buyer to really do a little due diligence with the HOA to make sure there's going to be no red flags popping up.
So, what due diligence would you recommend for a potential buyer to do? Obviously, the SB 326 is important because I've been noticing issues there where, and this is up with a lot of HOAs right now, where I'm seeing a lot of special assessments. I'm seeing a lot of HOA dues increasing significantly. And I'm seeing like, and it's natural. I mean, insurance cost is increasing, construction cost is increasing. Hence, these HOAs that were charging $300, it doesn't make, they can't operate at the same cost anymore. So they're having to make these increases. So if somebody, what things should buyers look into? Balconies? What else?
The balcony is an issue there, and any safety and health issues. And it could be other items that get called out on the structural engineers report. Say if it's a multi-story condo complex and there's railings going up and there's loose railings, I've seen that as far as being a safety and health issue. As far as due diligence goes, I would recommend that the agents and the selling agent and the buyer try to get the HOA docs up front before they even put the house in the market. And if they have a trusted lender, I recommend they try to get like the HOA certificate before they even have a buyer, so that they'll see what's going on and it can be reviewed and try to get an idea if there's going to be any red flags.
What is the HOA certificate? Like, what is that? I know you briefly spoke about it earlier.
Yeah, so what it is, like I said, it can be, some lenders have a one-page form, some have up to 4 pages. And what they're going to ask is how many units are in the complex, how many are owner-occupied, how many are investment properties, how much are the HOA dues, how many homeowners are delinquent on their HOA dues, is there any litigation going on, has the SB 326 report been completed in the last 3 years. So there's some are really quick and easy, and some are 3 to 4 pages long like that. And so it will vary from lender to lender, and also not all lenders have access to the non-awardable condos. So if you're working with a big bank, like Chase, Wells, B of A, the big three, they don't have these types of products available in most cases on these non-awardable condos. So you could need to start over with a brand new lender.
And this is important because if you're a listing agent, obviously that's going to cause your property to fall out of escrow potentially, or to have to switch lenders midway through the transaction. And if you're a buyer, it's going to obviously cause some changes potentially to interest rates or down payment requirements. So you'd want to know up front. Okay, so let's say I'm looking at the HOA financials during my due diligence process. What would I be looking for? Like, how do I know if an HOA is in good financial health? How do I know if it has reserves? And how do I know, and what is normal? Like what do we look out for in those situations?
So they're looking at the looking for the reserves, and there's a formula based on how many units are in there, how much is received on a monthly basis. I don't know the exact science behind that crazy algorithm. There is a certain percentage that they want to have, and they're also looking to see if there's any special assessments that are coming. Because that will be noted on the HOA certificate as well. So there's than just a simple is the budget okay? There's many things that kind of go along with that to make sure all the numbers kind of tie together. Yeah.
If there is litigation in the complex, is that still financeable via a non-warrantable loan product?
Yeah, it's kind of case by case. If they're because normally they just check a box that litigation, yes or no, and if it's yes, then we want to see what's really going on. And if it's something minor, like someone's finger got stuck in a gate, and that's minor. It's not going to be a major issue for all homeowners and having to fix structural situations. So, but if it's building defects, that's where you really have problems where a homeowner might say, hey, my foundation's cracked over here, and then there's a long investigation going on, and that could be a red flag and cause an issue.
Well, and then here's the important thing. Like, let's say that you live in an HOA complex and you're thinking about selling in the next 6 months, and the homeowners come to you and say, hey, we want to sue the builder because there's these building defects. Just know that lawsuit causes litigation, and that lawsuit can affect the financeability. And I tell you that because I own a condo in Camarillo, and they came to me very early on, like, we want to sue the builder. And I was like, no, I'm not for that, because I knew that it would cause financing issues for somebody looking to refinance, and potentially financing issues if somebody's going to be looking to sell, which if there's financing issues, it could affect supply, and it could affect the HOA prices as well too. And what they were trying to sue the builder was something very minimal as well too, that it just didn't make sense to to go through that.
A lot of homeowners don't really understand like the ramifications for that down the road for themselves or for, the whole project. Yeah, it's a great point.
Yeah. Okay. So let's talk about insurance. Here's what I've been seeing as well too. I don't know if you've been seeing it on your end. I've been seeing it where certain complexes aren't carrying the fire insurance required, which means that if the building burns down, like you can insure your condo from the inside, but generally in some cases the HOA covers like the exterior of it. Have you seen that at all?
As far as I know, the HOA, the insurance policy, needs to have that in place. I have not seen it where they're not having full coverage for that. If anyone does buy a condo, for the most part, you do have to have a small policy inside for your own contents called an HO6 or walls in policy. But yes, but HOA in most cases, it covers the outside, the structure, the roof. As far as I know, I believe they still need to have that in place.
I know that they need to have it. I know that there were several insurance or several HOA communities running into a problem where they were having trouble getting fire insurance. Let me ask you this. How would you verify, how would you go about verifying that they have the proper insurance to be able to make sure that your investment is covered?
I believe the banks look at the master insurance policy and they'll look at the amount of coverage and tie that in with the number of units. They want to have a certain percentage for each unit to make sure that is covered in case of total loss. Or sometimes they can get around it by if the company is going to guarantee that they have full replacement cost coverage to rebuild everything, that can get around it as well sometimes.
Okay. Let's talk about we already talked about the down payment requirements. We already talked about the difference between 10% down, 20% down is 2. We talked about the interest rates. Is there anything else as it relates to the loan products that are available, like who the banks are, what type of brokers offer this product?
It's going to be mainly mortgage brokers that offer these because we're working with a lot of non-QM lenders that will do these non-traditional products like DSCR loans, P&L loans. So it kind of falls in that window of those non-QM products. So you're going to have a tough time finding those at like a one-stop shop like the big banks. They don't have access to these. But some just make sure people know just because a project is non-warrantable does not mean that it's a bad purchase or it's a bad complex. Sometimes we're seeing it quite often with a lot of these places. They're just having a little hiccup with the paperwork or getting the insurance in place. And in most cases, you get it resolved. And so down the road, you are able to kind of sell your house traditionally, with, FHA financing or conventional financing. So it's not a death sentence. It's normally just a temporary, hurdle to get over, for your situation while you're getting in there to get the house.
Yeah. We had one where there was one investor that owned more than 51% of the units basically in that complex. So that one's probably going to be more of a permanent thing in there where they're not warrantable because of the concentration. Yeah. But the other ones should be pretty fairly easy. Can you approve on a spot basis versus the entire complex?
For FHA or
for non-warrantable?
Yeah, it's always case by case, like one unit for the most part. So when we do the non-warrantable condo loans, it's for that individual unit at all times. Say someone called me back a month later and say, hey, I saw you just closed in that project. Can you do it again? I can normally use the same HOA certificate and the same HOA docs and go back to that same lender. It helps streamline the process and kind of eliminate some of the fees as well.
Awesome. Cool. If somebody wanted to get in touch with you, Michael, what's the best way to do that? And any final words? Yeah,
best way is reach out via cell phone or email. Cell phone number is 805-407-5777. Email is mike@myhomelendinginc.com. So always available and happy to help.
Awesome. Amazing. Okay. Thank you so much. For our viewers, if you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that share button. And Michael, thank you so much for taking the time. And to our viewers, until next time.
Thanks, Jose. I appreciate it. Take
Awesome.
care, guys.